Welcome to another episode of Real Estate Investing Explained. Here's today's question. And the first question is about how I calculate returns on investment properties. So I've talked about how when I'm really looking for deals, I'm analyzing upwards of 10, 15, 20 deals a day. And people are asking me how I'm able to do that and still get other things done. And the reason for that is because I use rules of thumb when I'm calculating the returns for my rental properties. When you're calculating the numbers on a potential rental property, there are 4 big variables that you must estimate. And those 4 variables are the vacancy rate, capex, repair and maintenance, and property management. These numbers are going to vary from market to market, but there are some general rules of thumb that I've developed from investing in various markets across the United States. As you get more familiar with analyzing rental property deals, you'll also learn the general rules of thumb for your markets that you're investing in. By using rules of thumb, you can save a lot of time by eliminating deals that aren't even close to your investing criteria. When I was first starting to analyze deals, I would spend 25, 30 minutes on analyzing one deal. Now, I've gotten that analysis time down significantly, but also I'm not wasting time on deals that don't make sense to me. So I do a full analysis from beginning to end, only to get to the end and realize the numbers aren't even close. And so I figured there had to be a rule of thumb or something I could use to eliminate that property right from the beginning. So the first thing I do is look at the 1% rule. And that says that the monthly gross rent, which is just the total monthly rents that you're going to get in for that property, need to be equal to at least 1% of the total purchase price. So if you're going to be purchasing a property for, say, $100,000, you would like to look for a property that rents for at least $1,000 a month. Now, this is not a hard and fast rule. Just because a property meets this rule on the surface doesn't mean I'm going to run out and buy it. But again, it helps me eliminate those properties that aren't even close. If there's a property that's at 0.25% or even 0.5%, I know that that's probably not going to be a good deal. So I don't even waste my time looking at those. I only look at properties that are close to or at least exceed the 1% rule. And to take it even a step further, I've developed 2 sets of rules of thumb for those 4 variables that I just mentioned a few minutes ago. And then I run those numbers through my model very quickly. It only takes me about 5 minutes because I have an Excel spreadsheet that I've created that I just plug these numbers into, and it tells me whether this property is even close or not to what I require for my return numbers. If I use these rules of thumb and the numbers aren't even close, then again, I just eliminate that and I don't waste any more time on it and I go into the next property. But if using these rules of thumb, the numbers are pretty close, then I can go in, get the actual numbers, do more research on that specific neighborhood, that specific city, that specific type of property in that location, find out exactly what those numbers are going to be. I can call property managers, I can call real estate agents, I can really get the actual numbers that it's going to be and find out specifically what I expect that deal to be in terms of the returns. But I really like to use the rules of thumb to eliminate any deals that aren't even close to meeting my criteria. That allows me to save a lot of time and analyze upwards of 10, 20, 30 deals a day without wasting a ton of time. And so to quickly go through these rules of thumb, like I said, I have 2 sets. One is conservative and one is aggressive. And so for the conservative set, I set vacancy to 12%, I set capex to 5%, repairs and maintenance totaling 10%, and property management at 11%. For the aggressive set, I use 5% for vacancy, 2.5% for capex, 5% for repair and maintenance, and 8% for property management. Now, keep in mind that these are going to vary based on your market, the purchase price of the property, the classification of the neighborhood. So a Class B neighborhood property is generally going to have less vacancy than a Class C or C- property. So these numbers are going to get adjusted depending on the specific property that you're buying and where it's located. But again, these just give you a general rule of thumb to quickly go through the deal and find out if it's even close and if it's worth diving into more. And I know I just spoke through those numbers kind of quickly, but I have a post about this on Instagram and I also posted about it in our Facebook group. So if you're interested in connecting with other like-minded investors, be sure to go over and join our Facebook group. You can find it by searching Real Estate and Millennial Investing in the Facebook search bar. Then just look for the show's graphic and you can request to join the group. And also, like I said, on Instagram, you can follow me and connect with me. My username is the Robert Leonard. And again, that's the Robert Leonard. And I posted about this. I talk about it more in detail. If you have any questions, feel free to send me a DM, comment on the post. I'm happy to explain this a little bit more. And I hope it helps you guys cut down your analysis time and help you find more deals. That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.